Good morning. This is another edition of A Matter of Interest, a podcast by Moneyfarm. I'm Richard Flax.
And I'm Jack Amy. So this week we have two topics. First, a look at the Federal Reserve and how markets reacted to their meeting last week and Chairman Walsh's comments. And then a look at the stock market, particularly tech stocks, which have had a bumpy ride in July. So Richard, on the Fed or the Federal Reserve, we had a meeting last week. We had a decision, so no change, neither hiking nor cutting rates. But three members voted for a hike, and the market was not completely convinced, it seemed, by the output of the Fed on last week. What's your view on that?
Yeah, so very interesting. The new chair, Kevin Walsh, is trying to make some changes to how the Fed operates. I think he wants to reduce the amount of information that the Fed typically gives investors. The phrase that I think he used was that he wanted to kind of play the ball rather than the referee. And I think the idea is that, his idea is that investors should be looking at the macro data and drawing their own conclusion rather than relying on forward guidance or strong indications from the Fed as to what it would like to do. And then there are a bunch of other kind of committees and working groups that he's put together to look at various aspects of how the Fed operates. But I think, the conclusion is that, there are some changes that are taking place. And when you have changes, that can result in volatility. And I think that's what we are seeing, where investors are uncertain about the outlook for inflation, uncertain about how the Fed is going to react, and so are pricing in, a bit of risk for that. And in very simple terms, to me at least, that means that we should see two things, right? One, higher rates, particularly at the mid to long end, and two, more interest rate volatility. Now, what we did see was we saw kind of, shorter dated yields fall a little bit and longer dated yields rise. And you could say, well, shorter dated yields reflecting the fact that perhaps that the Fed didn't hike and longer dated yields rising because, perhaps reflecting the fact that some investors thought the rates perhaps should have done. I think you could make the case either way. Yes, inflation is higher than target, but perhaps, if you took out the supply shock from oil not looking too bad, you could make that argument. But it seemed like Walsh didn't want to make the argument. He didn't want to say very much of anything. And that approach, I think, has created a little bit of uncertainty. The result of that is that, in my mind, at least, as I say, yields are likely to be higher than perhaps they would have been, at least for a period of time. And that has some implications for portfolio construction that we will come back to, I think.
And I think it's worth noting that Walsh had a fairly long-standing stance that forward guidance wasn't his preferred way of setting monetary policy. And this was to be expected from him as a Fed chair. But it's maybe kind of useful to unpick why forward guidance might lead to higher rates here. And that's because US markets in general are very democratic in the way that they provide you with data, and across all sorts of services, and whether it's employment data from the BLS, whether it's EDGAR and the SEC, which is their service for releasing company earnings and various company documents in a very easy to access format. The Fed is also, or has been, a great example of this, whereby we used to get something called the dot plot, where you used to see kind of where various policy setting members thought interest rates would be. You'd get their expectations for growth and inflation. And whilst this didn't form the entire view of an investor's expectation for those macro variables, it did remove some of the uncertainty as to what the Fed was thinking, and therefore what the baseline case for monetary policy would be were those assumptions to be met. And we seem to be kind of moving away from that somehow, focusing more on the investor making those decisions, and therefore adding some error bars, or adding an element of uncertainty to that, which probably pushes the risk premium up and therefore probably pushes rates up, particularly at the longer end of the curve. So kind of past 5, 7, so 10, 20, 30 years, which is crucial not only for financial markets and people who hold those assets, but also for the US government who borrows in those markets, and therefore their borrowing cost has gone up. So kind of what's your view on whether this policy will lead to kind of not only more difficulty for markets to find the true value of these assets, but also the US government to be able to fund itself?
Yeah, so I think a couple of points to make. Look, firstly, I think we shouldn't say that there was such great certainty from the Fed.
Yes.
The Fed's track record in terms of forecasting is, I think, on average, perhaps no better, no worse than lots of other well-informed participants. And so, but obviously where they had a great advantage. I mean, in theory, where they had a great advantage was that they were being asked to forecast what they themselves would do, and even then, it was fairly challenging, right? So it's not a straightforward thing. Yes, I mean, to the extent, if my sort of starting point is right, which is, that yields will be higher as a result of this, yes, then this should cost the US Treasury more money, at least for a period of time. Walsh made, a lot of play of the fact that the Fed didn't have to do anything because markets were effectively tightening monetary policy by raising the long end. Yes, okay, but then if you'd wanted to send that signal, perhaps you could just as easily have raised rates, right? As the market, did long yields rise because of Fed credibility? Was that a sign of Fed credibility, or the reverse? So it's there is a sort of some inconsistencies to iron out there. And then I guess the other part is that there is a little bit of an irony in the fact that Walsh, I think, wants people to spend less time talking about the Fed, and at least for now he's achieved the reverse. Right? It should have been a very kind of almost a non-event in previous kind of Fed regimes. Right? Rates were left unchanged, not much to say, and yet obviously there's been a good amount of discussion subsequently. I guess you could say there was a good amount of discussion because 3 rate setters voted to hike rates, and that's a relatively rare event in the US, at least, perhaps less rare in the UK, where the Bank of England's Monetary Policy Committee shows perhaps less of a united front historically.
It's worth putting it's happened a handful of times since 2010.
Yes,
and the Fed meets 8 times a year.
But I think as I say, our starting point at least is that, rates may be higher than they would have been, long rates may be higher than they would have been, interest rate volatility may be higher than it would have been. And so from a portfolio construction perspective, the question that we end up asking ourselves is, well, what is the role for longer duration US government bonds in this context? And, the answer, I think for now at least, is, well, look, there is a place for them and there is absolutely a price for them, but perhaps it's the price is a bit lower, the yield is a bit higher than it would have been, a couple of months ago, given, how we expect the Fed to behave, at least for now.
And what's your view on how they'll act as a diversifier, particularly in rougher times when equity is in drawdown? Do you still think that they can be a sort of a padding or, I don't know, a help in more volatile times within a portfolio's context?
I think they can be. I think that and I'm not sure this changes very much with what we've seen from the Fed. Look, I think the challenge is that in a recessionary environment, yes, they have a very helpful role to play. In a stagflationary environment, right, where growth is relatively weak but inflation is relatively high, as we've seen over the last kind of 3 or 4 years, that's a more challenging environment because correlations between bonds and equities go up typically, and so the diversification benefit falls. And obviously the other challenge that you have is that the fiscal accounts are not super strong. Debt to GDP is relatively high versus history and forecast to go higher. And so when you think about it from a supply-demand dynamic, you're likely to see more supply kind of across the board. So there is absolutely a role for them. But I think which regime you think you're in matters a lot, and perhaps matters more now. Yeah. If you think that inflation is somehow going to be stickier than it was for the, say, 10 years after the global financial crisis. And so, perhaps correlations between bonds and equities, particularly at the long end, will be a bit higher. And so you need to think more creatively about the sort of portfolio construction that you're going to do.
That's interesting. And it's also interesting that you mentioned the sort of supply and demand dynamics, rather, of this market, because we've moved into a world where, as you say, debt to GDP is sort of well over 100%. It depends on the metric you choose, but kind of up to 120% relative to, say, 50 or 60, 10 or rather, maybe even 20 years ago. And the US government's balance of funding is not as stable and as secure. So the weighted average maturity of the debt is somewhere around 7 years, which means that on average, the government has to turn over that 120% of GDP over each 7-year cycle. And you'd maybe hope, if you're a fiscal policy setter, so whether it's Donald Trump or Scott Bessent, the Treasury chair, that you are going to, or Treasury Secretary, that you might actually have a Fed chair who was going to pull the long end down because it allows you a bit more fiscal flexibility to make your funding sources as a government more secure and try and kind of issue at the long end, or for us as holders of those assets, kind of increase supply at the long end at kind of 10 or 30-year tenors.
Yeah, well, look, it'll be interesting to see how, the Treasury chooses to manage its issuance. I think what we've seen is that, there's been less issuance, relatively speaking, at the long end, and in the past there's been some criticism of that from during the previous administration that they were doing that too much. I think we've seen that continue under this administration.
But in their defense, it's expensive.
Yeah, it is expensive, and the yield curve has steepened, right? So and that the events of last week have moved it a little bit higher again, I guess. So look, I think if you're in the Treasury, the situation on the margin, it's perhaps not helpful. But I think, firstly, there are other drivers that you need to consider in terms of, revenues versus your costs. And I suspect the Treasury is trying to focus on managing that process. I think that there has been talk of, and you could see changes to regulations that allow banks or encourage banks to hold more US government debt on their balance sheets. And, if you were trying to inject more volatility, or one consequence of what you were doing was to inject more volatility into the interest rate kind of environment, then, having increasing the kind of demand for held to maturity government debt is perhaps one way to go. And so we might expect to see that in the coming quarters. But I don't think it's a marginal challenge for the Treasury. I think the Treasury probably has other challenges in terms of where their deficit is at the moment. So I think that would probably be more of a focus than this.
So potentially lots of unknowns, but it's going to take both the market and the Fed and its with its new look some time to get used to each other.
Yeah, I think that's right, and it'll be, as we say, in the coming meetings, it'll be very interesting to see how that voting dynamic shifts. Obviously, there was a clear majority to leave rates unchanged. If we see inflation deteriorate, you would expect that to shift again,
and potentially more dissenters.
Yes,
brilliant. Thank you.
Before we continue, a quick note about Moneyfarm. We're a digital wealth manager with a simple purpose: to combine passion, expertise, and technology to give clients the 3 building blocks of investment success: access, advice, and low cost. Today, we help people manage their wealth through investment portfolios, pensions, ISAs, cash savings, and self-directed investing. All accessible through our platform and app. Whether you prefer to make your own investment decisions or receive expert guidance, our services are designed to support you at every stage of your financial journey. Alongside our team of investment experts, clients can also access Bastion, our AI-powered agent, which provides personalized insights and clear, accessible guidance to help them make more confident financial decisions. As always, remember that investing involves risk. The value of investments can fall as well as rise, and you may get back less than you invest. The views expressed in this podcast should not be taken as advice. Now, back to the conversation.
So, switching topic to the stock market, and again, another focus on tech stocks, which we spend more and more of our time talking and thinking about. It's been a pretty bumpy July, and we've seen lots of volatility, both in US markets, but also in some other markets, and again, particularly Korea. But is it kind of, or can we rather, start off with just a headline of what's gone on in US tech markets and the various earnings that we've seen since last time we recorded, particularly, I would say, Microsoft and Meta, and maybe touching also on Apple and Amazon, who reported over the last 2 weeks.
Yeah. So a couple of points from my perspective. Obviously there's this sort of, quarterly dance that goes on between, not just tech companies, US companies in particular who report quarterly, where they set expectations.
Yes.
And then they try to beat those expectations. And, you have the expectations that they set, you have their results, but then you also have the thing that you can't know, which is actually what's really priced into markets and how investors will really react. And that can be a function of really what sell-side analysts expect, what buy-side analysts expect, how investors are actually positioned, particularly leveraged investors, right? Who may be forced to do things if market volatility sort of picks up. Anyway, so there's a chunk of moving parts every quarter that you kind of have to consider. What we got, I think, was relative clear winner, which was perhaps Microsoft, earnings coming in ahead of expectations and the equity market reacting very positively to that. whether a company that big can really change its value by more than 10% in a day on the back of a single quarterly earnings release, that feels a bit of a stretch, right? And you think about a relatively highly rated stock, in theory, it's embedding, a couple of decades worth of forecasts in its share price, and those shouldn't change quite as quickly as the stock price movement would suggest, in theory. But leaving that to one side, Microsoft clearly did well. The market, quote, collectively liked it, and the stock went up. Meta, by contrast, worse than expected and sold off as a result. So some sort of level of consistency there in terms of the relationship between what was expected, what happened, and how the stock price actually reacted.
And there was a sort of, to add some numbers, there was a weird mirroring going on there where Microsoft, as you said, beat earnings per share expectations by in the order of 12%. Meta did the inverse, so missed by roughly 14%. And they both had kind of Meta dropped nearly 10% and Microsoft was up over 10%, I think, at certain points the next day. So you did at least see the market be relatively fair on either side to both of those companies.
Yeah, there was some differentiation, and that somehow matters to us, given that we're sort of holders of a lot of these indices. Outside of those two, results from Apple and Amazon, to our minds at least, were relatively solid versus expectations. Apple's growth expectations, generally speaking, perhaps a bit limited. A bit more limited than some of its peers, and also, by the way, showing significantly less capex spend, right, as the real outlier on the capital investment side. But iPhone sales apparently, were better than some had feared. And so you saw decent results versus kind of pretty robust expectations, as we've said before. The S&P earnings, year-on-year earnings growth is well above the long-term average, and you would say unsustainably so, given that you shouldn't expect corporate earnings to be growing at 20+% on a sustained basis.
When the companies are so large.
When the companies are so large, and the index is already a decent representation of at least some part of US GDP. So a decent picture. I think continued concerns among investors about the return on capital that you're going to get from all of this capex spend. In general, the capex numbers are continue to be very large. These companies continue to feel the need to spend to stay competitive, and you've seen you say free cash flow coming down across the piece, and the return profile of that, the incremental return on that capital expenditure is still quite unclear.
And it's worth and I think this was maybe one of the differences between, say, Alphabet and Microsoft, who maybe didn't have quite the impact on free cash flow, or at least not that I saw, where Alphabet went negative for free cash flow for the first time since their IPO. And I think Meta also showed very similar numbers. So they went from $8.5 billion of free cash flow this time last year to 790 million, so a drop of 90%, which shows precisely what the market's worried about, where you had these cash generative businesses that are now pushing all of that cash into AI capex. And the numbers are really, really quite large, because the fundamental strength of the business hasn't really changed. They're still generating lots and lots of cash despite the earnings beats or the earnings misses. However, where that cash is then going, as in not now to shareholders, but to suppliers in the further down the AI supply chain, is scary markets.
I think that's right. Look, there's a couple of other things to consider, right? One is around equity issuance. Obviously, We've seen the SpaceX IPO. We've talked about that in the past. If you have less free cash flow than you have less scope to buy back stock. And a lot of these companies have been buying back stock. So you are in net, and then obviously you have a potentially a number of other very large IPOs that will come to market over the rest of the year, or now, I guess, in some cases, perhaps into 2027, depending on any given day. But it's also potentially right to think that the lack of equity issuance that we've seen in aggregate over the last few years, and the strength of share buybacks have helped potentially to support on the margin. There've been an incremental support for markets that perhaps is shifting a little bit, right? And so that's something that we need to consider, I think.
Yes, definitely. Switching a bit to potentially where some of these AI investment dollars are flowing, we've also seen a lot of volatility coming from Korea. And I think it's worth, again, noting what's going on there. Not only because it's a larger and larger market, it's still classified as an emerging market, but may soon become a developed market and is very, very large. But also the two largest companies that are well over half the index in the Kospi are both kind of at that baseline of the AI supply chain. They are kind of semiconductors or near semiconductor producing firms. And so a bit of a bellwether for what's going on in the rest of the market, because these are at least some of the benefactors of all of this AI capex. And we've seen lots and lots of volatility. The index, as in the Kospi, was down 25% in July, and we've seen a lot of kind of intraday circuit breakers. We've seen a lot of leverage be applied and then be taken off, or in some cases be yanked from certain investors, and it's been choppy.
It has been, but I think we need to make a distinction between the sort of market structure discussion and the actual company fundamentals. And the market structure, as you say, has been there's a lot of leverage in the Korean market, a lot of retail investors, borrowing to trade these stocks, and I think some of the volatility that we've seen is a function of that, rather than necessarily a kind of volatility in the operating environment. Now, the operating environment is perhaps not volatile, but is uncertain, and it's uncertain because demand is extremely strong at the moment, but it's also not, it's not clear how far into the future you should reasonably extrapolate that demand, and that creates a challenging environment because it's not predictable. It could be really, really good. It could be a bit more challenging, and so that combination of leverage players, in many cases all betting in one direction, a good amount of uncertainty, positive or negative, about what the outcome will look like, and potentially a dynamic for sentiment that can change very quickly, has created this volatility. Now, I guess you would say from our perspective, the answer is perhaps not to do very much, right? There is a time horizon that is much shorter than the time horizon that we follow typically. And that volatility is somehow within that time horizon. So the playbook generally says, try and keep your long-term focus, try and keep yourself well diversified, and let this, market volatility or this leverage sort of play itself out. Provided, of course, you're sort of comfortable with where you think the long-term fundamentals are. And broadly speaking, I think that's what we're trying to do, right? We're not trying to take we see what's going on, we monitor what's going on, but actually in terms of, is it forcing us to make a decision? Not really.
But it's useful to maybe explain away some of these things, because again, if you've had a market, and I mentioned it's down 25%, when I checked this morning, and it's the 3rd of August 2026 today, the market's still up nearly 50% this year. And what it maybe is worth mentioning is that does begin to, if you have Korea in one index and not in another, you can see some performance deltas between the two, which maybe kind of over the short term are noticeable. But as you say, if you stretch this out for our holding period, which tends to be a number of years, it's not yet at a point where we think immediate action or more attention is needed.
No, I think that's right. Look, but I also think that, the other side of this is that you need to monitor these moves, because you might conclude that there's, it's market structure and that it's nothing fundamental, or you might come to a different conclusion, right? So you can't know that until you've sort of dug into it and tried to understand as best you can what's actually gone on here.
Brilliant. Well, that was very, very interesting. And I think that is all I have to say.
So where does this get us in tech space? Look, the operating metrics for now look strong in absolute terms, in some cases perhaps not as strong as investors had hoped. The focus on capital expenditure and the return on that capex, we think, is not going to go away. So you might expect to see continued market volatility. And clearly we've seen that there's a lot of leverage in some of these stocks, in some of these sectors, and that has played itself out, as we've seen in the US and in Korea, in terms of some pretty sharp market moves. As I say, our approach and our philosophy is to try and maintain a diversified portfolios, to try and take advantage of of the volatility we see. We do see, as you described, as for instance between Microsoft and Meta, you do see a differentiation between different stocks, between different sectors. And that differentiation is important for us, because that's how we can try and construct portfolios that are robust. But we do spend a lot of time talking about tech as a real driver, not just of equity markets, but also of the global economy. There are some really important questions and really interesting questions about how the economics of AI ends up playing out, and so we'll continue to look for signs, not just within the tech sector, but importantly outside of the tech sector, their customers. Are their customers really beginning to drive value out of all of the AI investments that they're making? And I think, as we've said before, we'll get greater visibility over the coming kind of months and quarters. But this time next year, I think we'll, to pick a random point, we'll be looking pretty closely for signs. We'll be looking for evidence that companies are saying, yes, we've really driven value, we've improved our margins, we're growing faster, we are better businesses as a result of these investments. Because otherwise, at some point, these CEOs are going to ask why they're spending the money they're spending. So, lots to unpack. Very interesting. And all we've got time for today. We will be off for a couple of weeks, I think, but should be back at the start of September.
Yes.
To take stock of where we are. Thank you very much for listening, and look forward to speaking to you again soon.
Please remember that when investing, your capital is at risk. The views expressed here should not be taken as a recommendation, advice, or forecast. If you are unsure investing is the right choice for you, please seek financial advice.